Adolf Hitler, the definition of evil. He waged war for 6 years on the world, and one night in his bunker, he wed Eva Braun. And the next morning, he blew his brains out. Marriage is hard. So is buying and selling a company. So I currently am the CEO of a wealth management company. We have almost $1 billion that we manage. And one of the reasons I'm here is we have an exit practice. So we actually work with a lot of professionals that are in this room. So our advisors, when they have a client that's getting ready to sell a company, we plug them into the tax people, the M&A guys, the business brokers. And then our job is to create the financial plan before they exit, so that when they exit, they know what they're doing with their money and they invest it wisely. And then hopefully we're the company that they let us manage some of their money. So that's our practice. And I've met some great people here, but I'll be around at dinner time and afterwards to connect with anybody else that if you think you've got a service that could plug into our clients, I'd be happy to talk to you. Peter Thiel, one of my favorite people on the planet, I think he's one of the smartest guys around. He said, "Tell me something that's true that nobody believes, and I'll be interested." And I'm going to talk today about small cap IPOs. It may not be relevant to a lot of you here today, but if you stay with me for just a few minutes, I think you're going to see in the next 1 or 2 or 3 years how it may be useful information to you. And a small cap IPO is actually another form of an exit. I call it a flexible exit. I built a technology company way back in the early 2000s, and I took it from startup all the way through a small cap IPO, got listed on the American Stock Exchange, and then we got acquired by a huge company 2 years later, much bigger than us. They wanted our technology and our network. And so after that, I co-founded an investment bank, focused on small cap IPOs, so I know a lot about this topic. And I actually wrote a book, published it in January, called IPO versus VC. It hit #1 in 2 categories on Amazon in January, VC in the public equities category. And I wrote that book because I kept running into venture capitalists who completely have missed this sector of how to get an exit in one of their portfolio companies with a small cap IPO versus just selling it to private equity or to a strategic investor. So that's really the relevance here today, is this really is a potential exit for some of your clients that you're working with. And let me go ahead and get started on this presentation and show you a couple things that I guarantee you by the end of this, you're going to look at this very differently than how you may think about it today. That's been my experience with probably 100 conversations. So small cap IPOs, why did they decline over the last 10, 15 years? Well, a couple reasons. There was an explosion of VC capital. From 2011, it went from $28 billion of VC capital coming into the market to $216 billion by 2021. It's almost a 10x increase. When you have that much money coming into the VC world, they're writing bigger checks. So instead of going out and doing a $50 million or $100 million small cap IPO, you got VC firms and PE firms that are writing $50 and $100 million checks because they need to use the capital and get rid of it. Also, the mega cap M&A, Google, Microsoft, lots of other big tech firms are out there buying tons of companies. That didn't happen 15 years ago. Just Google and Microsoft alone buy 100 to 200 technology companies every year. So that takes a lot of the small cap market out of companies that would qualify. And then we had Sarbanes-Oxley came and made it more expensive to be public. We're going to talk more about that in a minute. So I am predicting a boom of small cap IPOs, and actually since I wrote the book and predicted that about 8 months ago, there have been a number of things that have happened that are very fascinating. One of the reasons that small cap IPOs are going to come back strong is because of AI, because AI is lowering dramatically the cost. If you talk to a venture capitalist that's got a company in their portfolio that's maybe doing 200 million in revenue, and you say, what about a small cap IPO? They say, oh, it's too expensive. It's not anymore. Larry Goldman, the CEO of Goldman Sachs, just a month ago, came out and said, we can do 95% of an S1 registration statement. By the way, S1 registration statement is what you file with the SEC when you do an IPO. It typically costs anywhere from about $500,000 to $1 million in legal fees. 22 years ago when I did my IPO, it cost me $500,000 just in legal fees for that. Larry Goldman came out a month ago, said, we can do 95% of an S1 registration statement that took a team of 6 attorneys 2 months in 20 minutes using AI. So literally, they just took the cost of the legal costs going from $500,000 to $1 million down to probably $50,000 to $100,000. Not all the lawyers are going to be doing that right away, but it's coming. And I've talked to a few other lawyers in the business that are starting to do that. Audit fees. Blockchain's going to just dramatically lower the audit fees. The big 4 firms have been resisting that because they know it's going to kill their margins and their revenue, but they're starting to adopt it. That's the second biggest cost when you go public is your audit fees, because you have to have a public audit. It's different than a private audit. It's more expensive. And those costs are also going to come way down. And then just market efficiency. Everything, AI is going to literally decrease the costs in every aspect of going public. So that's one of the reasons there's going to be a big boom. I got a question for everybody. Microsoft, Apple, Amazon, PayPal, or Tesla, which one of those companies was a small cap company when they went public? By the way, let me define small cap. It used to be just the market size of a company. 100 million to $1 billion was small cap. Now it's like 200 million to 2 billion. Mid cap is like 2 billion to 10 billion, and then large caps 10 billion to 100. So it's just the size of the company. Micro caps under 100 million in market cap size. Which one of those 5 companies was small cap company? Any guess? Anybody want? Tesla? Actually, it's a trick question. Every single one of them was a small cap company when they went public. Amazon only had a $400 million market cap when they went public. Keith Roboy, he was either on the board or a C-level at PayPal, LinkedIn, Square, Yelp, and Zoom when they all did their IPOs. So he knows something about IPOs. Now he's a partner with Peter Thiel's Founders Fund, and here's what he has to say about going public early. He said, I believe companies should go public as soon as possible with as little as $50 million in revenue. I like the accountability, transparency, and discipline that going public brings. You have the capital, resources, and equity to be strategic. Sometimes when you are a private company, there are strategic access that you can't get your hands on. Think about where Meta would be if they hadn't acquired Instagram and WhatsApp. So he's a leading voice in Silicon Valley right now, pushing companies to go public earlier because of all the reasons he just said. So there's $4 trillion of liquidity in small cap companies. That's a lot of liquidity to take advantage of if you want an exit or if you're a VC looking for an exit. 9 strategic benefits of going public. Now, this is the one slide. If you're going to take any pictures, this is the one slide that sums up pretty much my presentation. I'm going to go through all 9 of these in just the next few minutes. And one of the things that I've heard consistently when I've talked to VCs and founders about why aren't you thinking about going public is it's too expensive, it's too hard. Well, the expenses are coming way down, and yeah, it's hard. It is not easy. It's like how hard it is to buy and sell a company. It's a lot of work to go through an IPO. But once you do the work, things get infinitely easier in some ways, which I'll talk about in just a moment. Okay, so let's talk about the number one thing. There is a premium for public companies because of liquidity. The liquidity premium simply says, I'm willing to pay more for this company that's the same company here that's a private company because I can buy and sell this, buy it today and sell it tomorrow, and if I invest over here, it may be 5 or 10 years. That's called the liquidity premium. There's another reason public companies trade for a premium. It's because of the transparency, improved governance, the financial transparency. All those things add up. So the typical company, if you take two companies, private and public, same business, same financials, public company is usually trading 50 to 100% more in value at a higher valuation. So here's the question I have for you. If you're big enough to do an IPO and 50 million in revenue, if you've got strong growth, I would prefer 100 million in revenue, but if you've got strong, clear growth, that's the key thing for small caps. You don't go public as a small cap company to get money and fix things. You go public as a small cap company to grow, accelerate growth that's already working for you. That's really fundamental. Not everybody with $100 million in revenue should go public by any means. I'm not suggesting that at all. But if you do have really good growth and you're 100 million in revenue and you're looking to go raise 50 or $100 million, and you can raise that at a 50% higher valuation doing an IPO versus a private round, what are you explaining to your shareholders? Why you're not doing the IPO, taking the IPO route? Well, that's a question you should be asking yourself, because everybody in the past is, it's too expensive. My question to you that I want you to think about is, how expensive is it not to do it? Nobody really considers the opportunity cost of not being public. So be thinking about that, because here's one big, huge opportunity cost. Just a lack of your valuation is going to be smaller if you don't do it. Second thing, faster, easier capital raises. I saw a little clip of the guy the founder of Waze, you know, that mapping app that Google bought. He started the company, sold it in a year for $1 billion to Google. And in this little clip I was watching him, he said the hardest part of that whole experience was raising the money. And so all of you founders and people out here have been involved in raising money for your own companies. I've raised 22 rounds of financing for my own companies over the years. And the IPO was the most work I ever did to raise money. But when it came to talking to the investors, it was the easiest. Literally, when I went out on the roadshow with the investment banks, I did a week in Europe and a week across the US. I would get into a room, they'd have, you know, maybe a half a dozen institutional guys, and I'd do literally a 40-minute presentation, and then on the spot, they would make commitments. And then the money showed up in my account during the IPO. That was it. There's no due diligence. There was no real intense after questions and interviews and everything else. It was an entirely different experience. And then once you're public, there's several ways to raise money, like pipes. Does any of you know what a PIPE is with a public company, how that works? It's an acronym, stands for private investment in public equity. So it's just you're raising money in a private deal. You're not doing it publicly. Warren Buffett invests in pipes all the time. There's over $100 billion of pipes that are invested in small cap companies every year. There's tons and tons of money. So I did a pipe after I went public. There was a company, a competitor in Canada that I wanted to acquire. It wasn't a lot of money. It was like $5 million. I had the cash, but I didn't want to use it because I knew I could just go do a pipe. So I went to my board on a Friday. I said, here's how much money I want. I want to raise it in a pipe. I've got an institutional buyer that wants to buy it. He'll buy it at a 5% discount to our stock price, because when you do a pipe, the stock's locked up for 6 months, so they don't get instant liquidity, so it usually requires a little discount. And the board said yes on a Friday, and literally 7 days later, I had the $5 million in my account. That is a wildly different experience than raising money as a private company. So another huge, huge benefit when you go public is the access and the speed that you can get your hands on capital. Another big benefit for all the shareholders, which is the founders, the investors, the employees, is you have liquidity. And this is what I call a mini exit. If you're a founder and you do an IPO, that's a liquidity event, but you may only sell 5%. You may hold on to 100%. You may sell 1% every quarter. You have that total flexibility now versus a one-time event where, boom, you've sold the company and you got your check, and now they're going to take your company and 10x it, but you're not going to participate in that. You go public, you can step out of the way and have all of your shares and let somebody else 10x the company and enjoy a lot of that appreciation if you don't sell many of your shares. So the flexibility is amazing for you as a founders and also for shareholders on having public equity. This is a huge one, and for any of the founders in here and entrepreneurs who've built companies, getting good talent makes the difference between your success or not success. And here's the deal. If you're a public company and I'm trying to recruit you, and this is a private company, and they're trying to recruit you, and they're offering stock options in a private company, and I'm offering you stock options in a public company, and everything else is equal, you're taking the job with me. Public equity wins every single time because you know the price, you can see the company history, hopefully you think the company's going to do well, but now you're going to have liquidity on those stock options, usually starting within a year, maybe 2, just depending. Whereas a private company, you may never get liquidity, and it could be 5 or 10 years, right? So it's way easier to recruit. The president, after I went public, I recruited a guy who was with a company 20 times our size to be the president of our company. And I never would have got him had I not been public with public options. Acquisition opportunities. So here's a big one for this group. If you're public, it is so much easier to acquire other companies versus if you're private. Why? Number one, price discovery. You're not arguing about valuation. The valuation is public. There it is. That makes a big part of the negotiation a lot easier. Number two, you're a public company, so it's way easier for them to do due diligence on you. There's tons of documents. You got audited financials. You got quarterlies. Way easier for them to do due diligence on you as a public company. And a couple other factors are, now as a public company, you can use shares to acquire companies, and you can do that as a private company, but it's a lot harder because you're fighting about valuation and everything. If you've got public shares that are liquid, much more attractive to private companies. And then you can also use cash, or you can go raise the cash if that's all they want. So huge benefit. You got major competitive advantages when you're a public company and you can use stock as currency or go raise the money really quick. And then the other thing that's really magic about public deals that you don't get as a private company typically, and that is accretive acquisitions. Now, what do I mean by accretive acquisitions? So if you're a public company and you're earning 50 cents a share and you're trading at a 20 times multiple, 20 times earnings, and you find a company and you can acquire them for 10 times earnings, your earnings per share is going to go up, and you're going to be valued most likely on your earnings per share and some multiple, right? So that's called an accretive deal. So if I'm trading at 20 times earnings and I buy a company that I got it for 10 times earnings because they're private and they thought that was a great deal, I just increased earnings per share for all the shareholders. I just made myself wealthier for all my shareholders. And you can just keep doing that over and over and over again, which is another big advantage that public companies have when doing acquisition deals. Okay, increased sales. After we were public, I literally did an around the world, because we were signing up companies to license our technology, which I'd been trying to do for years. After we were public, I literally was 100%. I got Canada, Australia, France, and India on one around the world trip that licensed our technology, because they look at a public company, huge status increase, lots of credibility, they can see who you are, they can look at your financials, make sales way, way easier. And that kind of goes hand in hand with the last few benefits. You get a lot more media exposure. You know, I got on the financial news a number of times. I actually brought, this is the gavel that I actually used to ring the opening bell at the American Stock Exchange. And it's kind of a surreal experience, but you ring the bell and then you immediately go over and talk to the financial news on TV. And it was a fascinating day for lots of reasons, but I rang the bell. I felt like $1 million. I'm being interviewed that afternoon, right after the market closed. I'm doing a shareholder conference call with all my shareholders saying we rang the opening bell. and the lights went out. It was a blackout. And I thought, oh, they'll be back on in a minute. And then they didn't come on in a few minutes. And then 30 minutes later, they didn't come on. And I don't know if any of you remember this, but this was just 2 years after 9/11. So this was in 2003 when I did my IPO. So New York was really edgy still, and the entire city was blacked out. And it was that, I don't know if you remember this, but it was the blackout that lasted like 2 or 3 days for the whole city. And so my call ended. I walked a couple miles back to the Marriott Marquis in Times Square where I was staying. Thought I'd just wait until the lights came back on. They didn't come back on. The hotel kicked everybody out of the hotel because we had no power lights in the hotel. So I literally was sleeping on the street that night until the next day when the sun came up and they let us back in the hotel. So that morning, I'm ringing the bell at the American Stock Exchange, and that night, I'm sleeping on the streets of Manhattan. That's how fast fortunes change in Wall Street, right? So innovation, growth, obviously more important than ever to be staying up on the latest and greatest, what's going on with technology and AI. And if you're a public company, it's way easier to raise money, to acquire assets. And global expansion. I kind of touched on this, but you get a lot of credibility internationally when you're a public company. Most of the people around the world and business people really give huge high status to companies listed on NASDAQ or the New York Stock Exchange. So just in concluding here, and then I'll open up for a couple questions, the thing that I talk to VCs about when they're thinking about, oh, I don't think my company's big enough, we should just raise $100 million privately instead of an IPO. It's like, what is it costing you to not do the IPO? And now they're thinking about that. It's really made a lot of them think. What is the cost of not being public? And it's pretty high when you think about it. A lot of it is hard to actually quantify, like attracting talent. It's pretty hard to quantify that, but you know that that is a major factor in your success as one of many examples. So if you're not ready and you don't have a portfolio company ready for an IPO today, next year or two, give me a call when you are ready or you meet someone that is. The costs are coming down. There's going to be a huge, I believe, massive growth in small cap IPOs. And thanks. Look forward to talking to any of you between now and the dinner if you're interested in having us do a financial plan for any of your clients getting ready. And we'd love to work with you on your professions. So thanks a lot. Appreciate it.